Okay, so the situation with USO, the US Oil ETF, just gets weirder and weirder every day. In today's video, we're going to discuss whether USO will have to liquidate their holdings after running into issues with their brokers. Welcome back to Patrick Boyle on Finance. We're back to talking about the US Oil ETF. I thought we were all done with it, but it's back in the news once again today. So let's start with a little bit of history. I've put up a few videos on this topic already, but oil prices went negative for a few hours the day before the expiration of the May oil contract last April. And the USO is an ETF that invests in oil futures. So it's kind of an interesting product in that it's an exchange traded fund that invests in futures. And as I explained in one of my other videos, the setup for futures actually works quite well if prices go negative because all of the margining requirements and everything else are in place to deal with negative prices. Even though they're unexpected, it's something that can be dealt with. The US Oil ETF had actually rolled their futures, so they were mostly uninvolved in that whole situation with negative oil prices. But what happened was that people suddenly realized that if oil futures could go negative, the USO could in theory go negative, or at least its NAV could go negative, and there were no systems in place to deal with that. And once again, I did put up a video on that topic, which I'll link to up there. The AUM, or assets under management, of the USO Oil ETF ballooned, and USO was no longer able to create new shares, and that allowed its share price to drift away from NAV, or net asset value. So a few things were going on. The makeup of the ETF was changed in order to no longer track the front month contract, which was what it kind of had done up until that point in time, and that was the idea of USO, was to track the front month oil contract. But the people who run the USO realized that this was a problem, and so they changed the way it was set up, so they were no longer just trading the front month contract, but they were able to trade longer dated contracts. So that sort of worked for USO in that it meant that they were less exposed to contango, which was also costing money for people who were long USO. And it probably was good for most people all around, but not really that great for hedgers. Now, it's worth noting, an interesting thing with ETFs is that they're not just used by people who are long the underlying contract. So there's a lot of people, a lot of hedge funds or institutional investors actually use ETFs in order to go short, and they're quite well set up for that. But you can only really use an ETF to hedge a long position if the ETF does the exact opposite of that long position. So as soon as they changed the contracts that were underlying the ETF, it maybe became less useful for people to use as a hedge. And so that was problematic within the USO as well. So then what's happened today? Well, in today's news, we're now learning that brokers, who are known as FCMs, which stands for Futures Commission Merchants in the world of futures trading, might now be unwilling to deal with the USO ETF for risk management purposes. And this relates to, I think, the most recent video that I put up on the topic of USO, where I said that it was starting to look like an options contract. So RBC Capital, Royal Bank of Canada Capital, is the USO ETF's only clearing broker, and RBC has informed the ETF that they are no longer prepared to clear USO's portfolio, specifically in the benchmark front month, but also, rather surprisingly, in any other months either. RBC has indicated that such limitation on USO is a result of their own internal risk management requirements and also directions it's received from other regulators in the United States, Canada, and the United Kingdom. So how do I know about this? Well, USO just filed an update to the SEC explaining what's going on. And in it they say that RBC, currently USO's only futures commission merchant, has expressly informed USO until further notice that USO may not hold positions in the benchmark front-month oil futures contract, and that it may not purchase any other oil futures contracts for USO's portfolio through RBC, whether or not such purchases are within the limits permitted by the exchanges. So RBC and other market participants, including other FCMs, have taken risk mitigation measures that constrain USO's ability to invest in the benchmark futures contract and other oil futures contracts. USO has been engaging in efforts to enter into additional FCM agreements for the purposes of the sale and purchase of benchmark oil futures contracts as well as other futures contracts. According to their filing with the SEC, to date, USO has not entered into any agreement with any FCM other than RBC, and it cannot predict with any certainty when it will do so. Now, USO's sister product, the United States Natural Gas Fund, which ticker is UNG, did experience similar but lesser stresses in the summer of 2009. First, what's happened is that its AUM exploded, a little bit like what happened with USO. Then it started experimenting with exotic instruments. Then its registered shares got depleted, once again like USO. Then its creations were suspended, much like USO. And then it continued to trade at a premium despite creations being suspended. And finally, the SEC failed to grant permission for the issuance of new shares, and then they changed their mind. The regulators basically got involved with position limits, and the fund reopened and lived to fight another day. So that's the story with the Natural Gas Fund. But the situation is different here with USO, as the problem is with their brokers and their willingness to take risk, combined with regulators possibly advising them in the background. Now, what does this mean for the oil market? At the moment, this is just really unclear. In the strictest literal interpretation of the filing, it could mean that unless USO finds an alternative clearer right away, the USO will be forced to liquidate all of its holdings before the next roll period. A looser interpretation might be that it's allowed to hold on to existing positions, but will not be allowed to add new ones. In a continuing contango market, this would see it run down its overall position over time. Now, RBC is not just a broker, but it's also an authorized participant creating and breaking up ETP units. And I explained what authorized participants were in a prior video. Once again, I'll link to that if you're really interested, or you can just Google it. But authorized participants tend to become the counterparties of the derivatives the USO acquires. So the long positions that the fund holds end up being offset by short positions taken by the fund's authorized participants. It remains to be seen what will happen with the USO ETF, and equally for us to work out what RBC Capital's exposures to the USO are at this point. Okay, so don't forget to hit the like button and to subscribe to this channel if you find this content interesting. And equally, do check out the Amazon links to my books in the description below. Bye for now.